July 15, 1815. Near Waterloo, Napoleon's final army collapses under British and Prussian forces. The future of Europe is decided on a muddy battlefield in Belgium 200 miles away. In London, Nathan Meyer Rothschild sits quietly at the stock exchange. He isn't a general, he isn't a politician, but he has something no one else does: information. Rothschild's private courier network, relay riders and carrier pigeons can move news across Europe in a single day. Official government dispatches take 3 days. From July 19th, his courier arrives. The message is clear. Napoleon is finished. Wellington has won. Rothschild doesn't celebrate. He doesn't announce the news. Instead, he begins selling British government bonds aggressively. Other traders panic. Rothschild must know something terrible if he's selling. Britain must have lost. Panic spreads across the exchange. Bond prices collapse. Then, quietly, Rothschild's agents begin buying everything in sight at rock-bottom prices. The next day, official confirmation arrives. Britain has won. The bonds explode upward in value. By some estimates, Rothschild earns the equivalent of billions in a single move. This wasn't illegal. There were no insider trading laws. It was information arbitrage, the strategic use of faster knowledge, and it revealed a truth that would define global finance for the next 2 centuries. Power no longer flowed only through armies or crowns. It flowed through debt, information, and capital. Over the next 200 years, a small number of banking dynasties would help construct the modern financial system. They financed wars, created central banks, and shaped the institutions that govern global money today. This wasn't secret history. It happened openly, through treaties, legislation, and formal partnerships with governments. The system wasn't hidden. It was legalized. Understanding this isn't conspiracy. It's financial history, viewed not through markets or charts, but through the families and institutions that designed the system itself. Their core business model was simple: lend to governance, finance conflicts, remain politically neutral, ensure that whoever wins still owes you money. In the 18th and early 19th centuries, European monarchies were permanently short of cash. Wars, infrastructure, and royal courts required constant borrowing. Governments couldn't issue bonds easily or raise capital through public markets. They depended on private bankers. Most banks were local. A London bank lent to Britain, a Paris bank lent to France. One family changed that. Meyer Amschel Rothschild began as a coin dealer in Frankfurt. He had 5 sons. Instead of keeping them together, he sent each to a different financial capital: London, Paris, Vienna, Naples, Frankfurt. This created Europe's first truly international banking network. Money could move internally across borders, bypassing restrictions that constrained other banks. More importantly, the family could lend to multiple governments at the same time, even governments at war with each other. When Britain fought France, Rothschild capital flowed to both sides. Victory didn't matter. Debt survived. By 1815, the Rothschilds were Europe's dominant financial power. They held massive amounts of government debt, controlled information flows, and proved that wars were won not by armies alone, but by whoever could borrow the most. From there, the model expanded. Governments drowning in post-war debt needed refinancing. Rothschild banks underwrote bonds, set interest rates, and controlled access to capital. By the 1830s, members of the family effectively dictated borrowing terms for Britain, France, Austria, and parts of Italy. Control of government debt translated into influence over policy. A government that couldn't borrow couldn't function. But debt was only the foundation. The real leverage came from controlling money itself. Most European currencies were tied to gold. Governments couldn't expand the money supply freely. Central banks changed that. A central bank could issue currency, set interest rates, and lend to governments beyond gold constraints. Britain's Bank of England already existed as a private institution. On the continent, new central banks emerged, often structured as private entities with state privileges. Rothschild influence appeared repeatedly, either as major creditors, shareholders, or advisors. By the mid-19th century, monetary policy across Europe increasingly flowed through institutions shaped by private finance rather than elected governments. But the largest opportunity wasn't Europe, it was America. In the 19th century, the United States lacked a permanent central bank. Andrew Jackson had dismantled the Second Bank of the United States, arguing that concentrated financial power threatened democracy. For decades, America operated without a central monetary authority, yet the country was expanding rapidly. Railroads, factories, and cities required enormous capital. American banks didn't have enough, so they turned to Europe. European capital, often routed through London, funded America's growth. Rothschild-connected agents handled bond sales and infrastructure financing. One of them, August Belmont, became a dominant figure in New York banking. Over time, a uniquely American financial power emerged. J.P. Morgan. Morgan consolidated industries, merged competitors, and stabilized failing corporations. He organized U.S. Steel, the first billion-dollar company, and restructured railroads that spanned the country. He didn't just finance business, he reorganized it. But Morgan wasn't isolated. His power rested on deep connections to European capital markets and banking networks. He became the bridge between American industry and global finance. That bridge mattered in 1907. A banking panic swept New York. Trust companies collapsed. Depositors rushed to withdraw funds. There was no central bank to intervene. The system was hours from failure. J.P. Morgan stepped in. He gathered the city's leading bankers, forced them to pool resources, and personally decided which institutions would survive. The panic ended not through government action, but private coordination. The lesson was unmistakable. America needed a central bank, and bankers intended to design it. In 1910, a small group of financial and political elites met in secret at a private resort on Jekyll Island. Over several days, they drafted the framework for what would become the Federal Reserve System. The design was deliberate. The name avoided the word central bank. Power was distributed across regional reserve banks. Ownership rested with private member banks. Public oversight existed, but operational control flowed through Wall Street. In 1913, the Federal Reserve Act passed quietly, just before Christmas. America had a central bank structured to be independent of voters and closely aligned with financial institutions. Within a year, World War I began. The Federal Reserve financed massive government borrowing. Money creation accelerated. War bonds flowed through banks. Debt expanded. When the war ended, financial power had shifted decisively to the United States. The next stage was global consolidation. The interwar period and World War II destroyed Europe's economies. American banks emerged intact. New institutions were created to manage the post-war world: the International Monetary Fund, the World Bank, and the Bank for International Settlements. These organizations coordinated currency policy, managed sovereign debt, and extended loans with conditions attached. Monetary authority became international, technocratic, and insulated from politics. In 1971, the final constraint disappeared. The United States ended the dollar's convertibility to gold. Every major currency became fiat backed only by government credibility. Central banks gained unlimited capacity to create money. Since then, money supply growth has exploded. Asset prices soared, debt multiplied. Those closest to money creation benefited first. The families changed, institutions grew larger. But the architecture remained today. Central banks coordinate policy globally. Governments borrow endlessly. Asset owners gain. Savers lose. The system operates beyond elections, beyond borders, and beyond public control. 2 centuries ago, bankers learned a simple rule: control debt, control money, control nations. That system still governs your financial life today. Understanding how it was built is the first step. Understanding where it leads may be the most important financial decision you ever make.